This actually was a really cool week. So like I was saying, there's some, tips on the Monday high of the week. So like you gotta let Monday go. It's really a back half of the week trading model because you need Monday's range and you need Tuesday's basically opening balance or price action activity. So once the price starts to tip its hand like it wants to be bearish, Tuesday has to take some liquidity from Monday. So hourly chart, easiest one is like right here, right? So buy side liquidity up here. Once that buy side gets taken, you want to see price working its way back bearish. That would confirm the Monday high. But because you you just don't know, like after such a strong rally here, you're not sure if price is going to continue bullish after just a retrace, or will it continue, or will it flip the script and go bearish? So of course, you definitively know here, but you can see the first signs of it when you use things like a measuring gap here or a measuring gap here. So once you get that determination, you definitely know it's bearish here. We've cleared below Tuesday. Monday's high is still intact. And then you're using Wednesday's range to set up your trading for Thursday and Friday, which in part makes this really hard because you're not trading Monday. You're maybe trading Tuesday. You're likely not trading Wednesday because you're not sure, but then you're like going hardcore Thursday and Friday. And what would make this very helpful is, obviously once you have that break of the previous day's low, we can't get up back above the high. We are just basically wicking in. So what do we have here? This in this cluster, black, green, the highest up close candle is this one. So this is where you'd want to be looking at your order block, and you got these very tiny candles with wicks. So you just take that wick, the low wick there, and that would be the basis for setting up that short. And you wait for the New York session or wherever you trade, and then you can go from there. But that would be the first clue, and then price breaks lower, stays below this high, finally makes a market structure shift. Once you get that market structure shift, then you're entering on the previous day's low, stop above the high, and then you're holding on. But if you use some measuring gaps, then you can actually get some better bearings. So I'll work backwards. I mean, the obvious first one is here, where you have this fair value gap that doesn't get completely filled in, just gets a little bit of a wick in. And so once you mark out that fair value gap, 15-minute or hourly chart, find the nearest swing high. Let's put this like that. Then you drop the 50% of the fib on the 50% of the fair value gap. So this one here, and let's just make that a little bit bigger. And so you just basically using this to help build a narrative of wanting to be bearish, right? So as price kind of works through, you have the previous day's low, consider this the origin of the move. And as price breaks each level of the ladder, you're working through that logic. So your goal is to get down to the 1.5 and then see if time will allow you to do so on Friday. And we can see as price kind of works its way through, comes back up, works its way through, comes back up, works its way through, wicks all the way down to the 1.5, can't even muster it to get back up top, works its way through, works its way through. And it doesn't flip that script until here, Tuesday the following week, where price consolidates around that level Sunday to Monday and then breaks the other way. Not that it's going to completely reverse, but that's what you have. So back to this weekly profile. I know you had asked about the Monday high. So once Monday closes on the hourly chart, you're just looking for the easiest swing high or low, right? Like it needs to take some liquidity, ideally going to Monday's mid. And when you kind of zoom in on this, you can see, all right, potentially it could be going here. I'm not sure how far, but you notice that this gap doesn't get completely filled in. And however you want to use it, whether you don't use dojis or not, but you definitely just, you can see there's a gap there. So that gap doesn't get completely filled in, and so you can use that as a confluence for measurement. So same idea, you take the 50% of the fib, you overlay it with the 50% of the gap that doesn't get filled in, the first one in a price run. And as price is running away, you're looking and seeing, well, can it even get somewhere? And if it can't even get past that zero point 0.5, coupled with the idea that the weekly profile is looking for this to get to buy side, and it starts to fail, then you have the first inclination that we have a Monday high of the week because we just got to this buy side. We're not even getting through this price run. It's not getting up to the next rungs of the standard deviation, the rungs of the ladder, and instead we're breaking down. And in fact, as we are breaking down, we have another gap that gets formed here. So it's just constantly formulating the narrative, measuring the narrative because a Monday high or Monday low of the week, it's kind of like a back half of the week where you have the most confidence. But when you have that confidence, you can really make you can make some big trades. So same idea as price kind of works its way through Monday's mid, is chopping around here, but it does create this gap and it leaves it open. So your setup is looking at that level, so 50% on top of the gap, 50%. And as price is breaking through the rungs of the ladder, so to speak, you're looking to see, okay, can we break through here? We've gone all the way to the 1.5. We start to reverse, but how far can we go? We can't even get back into the original consolidation. And I'm anticipating that we may be bearish. I see that we reject off of this level and we continue to push down. And as we break that definitively, then it's like, okay, at this point in time, before the rest of the week even plays out, I am pretty sure that we have a Monday high of the week, and a Monday high of the week will work off, Thursday will work off of Wednesday's range, and that's where you get your previous day low. This is right around 8 o'clock, 9 o'clock, 10 o'clock. So you're going into New York, but you have your narrative already built out. And then, like I said, whether it's that little tiny fair value gap, or really, this order block is probably the one. It's got the highest close of this cluster of candles, and it's just tiny wicks on either side, relatively speaking. So just using that as your basis, and then once you get this market structure shift, then any retraces you'd be looking for price to stay below that high, and ideally right at that 9 o'clock, you see that previous day's low gets revisited, and then you just work the logic, right? And the logic would be something like 230 pips worth of opportunity um, between that Thursday and Friday's lowest point. So yeah, pretty cool one.